The Bulls versus the Bears. Get in the game. www.tackletrading.com.
I was recently teaching a class about trend analysis, Fibonacci's, and whatnot. And what I wanted to do was I wanted to do a very quick, not extensive, just a very quick video on kind of Elliott Wave Fibonacci. Going to make it very, very basic so you guys can understand it. Obviously, it gets into a lot of detail. It gets into some advanced techniques and whatnot, but we're going to leave that to another day. What I want to talk about first and foremost is just Elliott Wave in general. Elliott Wave is a trend-following study. We have basically two types of trends. You have a bullish uptrend, you have a bearish downtrend. Now, in those trends, according to Elliott Wave, it moves in a series of waves. And we like to call it a tackle trading a wave count. And what the wave count is it goes up 1, down 2, up 3, down 4, up 5. So it goes in series of 5. So it looks something like this. Up 1, down 2, up 3, down 4, up 5. And then typically we'll see some type of reversal or continuation pattern or something along those lines. Now, understanding where we're at in the trend, understanding where we're at in terms of the wave count can help us understand how we want to approach the stock. Do we want to be aggressive? Do we want to buy the stock? Do we want to swing trade it? Do we want to position trade it? Are we going to trade options or the stock? Are we going to do credit spreads? Just a simple understanding of where we're at in the trend, where we're at in terms of the wave count can help us understand how to approach making money on the stock. So when we're looking at the very beginning of a trend, we're down here and the stock's going up a little bit, down a little bit, up a little bit, down a little bit, and then it breaks out and initially sets what is called wave 1. So once the stock breaks out of neutrality, this is now what we call wave 1. Now at the end of wave 1, it is going to establish a resistance zone. And what resistance is it's always above the stock price and it drives the stock back down in price. It's basically the area on the chart where, traders, hedge funds, institutions, you and I, we're all locking in profit because the probability is now for the short term for it not to continue to go up. The probability is actually for it to start coming down. Now here we draw our Fibonacci, and what we want to draw is we want to draw the entire motive wave. So this wave 1, this is called a motive wave. So now I've clicked on a Fibonacci retracement tool, and over here you can see percentages. The standard retracements that typically occur in the market are a 38, a 50, or a 61% retracement. A 21% retracement certainly can be considered a retracement. However, I see these more as a high base type pattern than I do a retracement. I'm looking for the stock in terms of when I want to buy. I want to buy it after a 38 or a 50% retracement. That's what I consider my zone. That's that strike's coming right down the plate. The pitch down the middle, and I'm going to pick up that big old bat and hit a home run. I don't mind a 61% retracement, but anything under 61, I automatically start thinking something else. I automatically start thinking, oh my goodness, is this reversal? Oh my goodness, is this some other type of movement that I was not anticipating? So I tend to shy away from anything that drives past the 61% retracement level. So now the stock will drive down into its 50% retracement, and once it starts going back up, once again that's called confirmation. That is confirming that we now have support. It is now time to buy. So now I'm going to draw what is called a Fibonacci Extension to help me understand where wave 3 will go into. And wave 3 is the longest of the wave counts. There's a lot of reasons for this, but think about it like this. Once the stock breaks out, it's not in the news a lot. You're not getting a lot of information. It's not getting upgraded. None of this. But once it's been in a trend for some degree of time frame, you're all of a sudden you get this news out there, you get this information out there, and it's like, oh my goodness, and it drives all the way up to 161, and then at 161, people start to once again lock in profit. And as you can see there, we're going to now draw our Fibonacci retracement tool. And then the next retracement is back down into the 50% retracement again. Wait for it to go back up, and it's time to, everybody say it with me, buy. it's time to buy, because now, you know, the stock is telling us, hey, listen, this is a really good moment in time. We should get out there and make some money on it. Now go ahead and draw your Fibonacci extension tool. And now, because this is the longest of the wave counts, we are going to see what is called slowing momentum, and it's going to drive into the 61.8% range. Now that it drives into the 61.8% range, we're now going to once again lock in profit. And we're going to lock in profit because you don't have any more probability, and it's going to retrace once again into the 50% range. Now, in looking at understanding all of this, we love retracements, we love breakouts, but when you're at the beginning of a trend, because you have so much more time left in that, you can approach that stock in a lot of different ways. You can position trade, you can invest, you can, you know, start writing covered calls against it, you can sell naked puts against it, you can, you know, buy options a little bit longer term and whatnot. But when you start getting into the tail end of the trend, you are really kind of limited in your approach as a trader, instead of, you know, investing here, because really, what can I expect? I can only reasonably expect for the stock to come back into resistance, because we're at the end of the trend. Now, I'm not saying that a reversal is going to form. It certainly could form a continuation pattern, break out, and start it again. But again, I don't know what the probability is any longer. So here, if I'm a buyer right there, I'm going to be a seller right there, which means I'm going to swing trade it. If I'm a buyer right here, I'm going to swing trade this up into right there because I don't really have it. But if I'm a buyer back here or here, I can be a little more aggressive. I can be a little more, I can give my stop losses a little bit more room. I can hold the trade through longer. I can approach it in a lot of different ways. And it's just because you're at the beginning of a trend versus at the end of the trend. So once again, this approach, technical analysis in general, but an Elliott Wave Fibonacci's, understanding where we're at in the trend, can help us determine the style of trade and the type of trade. It can also help us understanding how aggressive or conservative we want to play stop losses. And it is absolutely, vital in understanding where to target. If I'm a buyer right here going into wave 3, I'm going to be very aggressive on my target at 100 to 161 Fibonacci extension level, versus going into wave 5, I'm going to be a little more conservative. I'm going to do a slowing momentum target, versus coming in at the end of wave 5, I'm just going to target the previous areas of resistance, ladies and gentlemen. So once again, Matt Justice for Tackle Trading. Hope you enjoyed the quick discussion on Elliott Wave Fibonacci's and how we can utilize it in our